Most people assume the dangerous debt belongs to people in their 20s, but when I worked in banking, the age group that worried me most was almost never the youngest customers. The people sitting across from me saying, "We're managing, good jobs, families, mortgages, cars on the drive, holidays booked." And quietly underneath it all, credit cards, loans, car finance, overdrafts, and financial pressure that had become completely normal. The older people got, the less dramatic the debt looked, but often the heavier it became, because debt in your 20s usually arrives through lifestyle. Debt in your 30s arrives through compression. Debt in your 40s often becomes maintenance. And debt in your 50s and 60s increasingly becomes responsibility. That was the pattern I kept seeing behind the counter, and the data confirms it. Your 20s, when debt feels normal. According to FCA Financial Lives data, adults aged 25 to 34 who carry unsecured debt owe a median figure of around £12,500, including student loans. Even excluding student loans, the typical figure still sits at around £2,100 in consumer debt alone. That includes credit cards, car finance, personal loans, and overdrafts. And honestly, this was the age where debt often felt completely harmless. Infrastructure, not danger. I remember a young man who came into the branch wanting to increase his overdraft. He had a decent graduate job, good salary progression ahead of him, confident, polite. And when we looked at the account together, nearly every pound of his monthly pay had already been allocated before it even arrived. Car finance, phone, gym, subscriptions, buy now, pay later, credit card minimum payments. Nothing looked catastrophic individually. That is what made it dangerous. The debt looked modern, normal, socially acceptable, and because everybody around him lived similarly, it never felt extreme. That is what people misunderstand about debt in your 20s. It rarely arrives through crisis. It arrives through normalization. Your 30s, the compression decade. By the time people reach their mid-30s and early 40s, FCA data shows the median unsecured debt figure remains high at around £7,500, and for many households, that exists alongside mortgages, often exceeding £140,000. This was the age group I saw most often looking exhausted, not reckless exhausted. Mortgage, children, nursery fees, weddings, school uniforms, food inflation, car finance, house repairs. Everything arrived at once. I remember a couple sitting across from me one Saturday morning, trying to work out why they never seemed to move forward financially. Together, they earned well above the national average salary, and yet every month ended the same way, very little left. Not because they were wasting money, because the machine around them had become enormous. Childcare alone was costing them over £1,200 a month. Then came the mortgage, energy bills, insurance, petrol, life. They kept saying, "We earn good money. We don't understand where it goes." And honestly, I understood exactly what they meant. The 30s are where many people quietly discover that a good salary and financial margin are not the same thing. If any of this feels uncomfortable, that's normal, because most people think debt is supposed to look dramatic. But most debt doesn't. It looks ordinary. That's why it survives so long. The people I worried about most behind the counter were rarely the people panicking. It was the people who had quietly adapted to carrying financial pressure permanently. Your 40s, managing fine. According to FCA figures, people aged 45 to 54 who still carry unsecured debt owe a median figure of around £3,800. That surprises people because from the outside, many people in their 40s look financially established. But this was the age group that worried me most. Not because the debt looked catastrophic, because it looked manageable. People rarely described themselves as struggling. They said, "We're managing fine." That phrase stayed with me for years, because managing often meant the bills were paid, the mortgage existed, the holidays still happened, the children were okay, nothing had collapsed. But underneath it all, many households had almost no resilience. One redundancy, one illness, one major repair, one disrupted income. And everything became fragile very quickly. I remember one man in his late 40s who earned what most people would consider an excellent salary, but between private school fees, a large mortgage, 2 finance cars, and helping his adult son financially, he was permanently close to the edge. Not visibly, quietly. That is what debt often looked like in people's 40s. Not disaster, maintenance. Your 50s, the debt that was supposed to be gone. According to FCA data, adults aged 55 to 64 who still carry unsecured borrowing also owe a median figure of around £3,800. The number barely drops from the previous age group. That matters, because many people assume debt naturally disappears with age. Often it doesn't, and this was usually where another emotional layer appeared. Adult children moving back home, helping with deposits, supporting university costs, paying off relationship breakdowns, helping grandchildren. I remember one woman in her late 50s who had almost cleared her debts completely. Then her daughter's marriage broke down. Within 18 months, the credit card balances were back. The overdraft had returned, and part of her savings had disappeared helping with rent and childcare. She didn't resent it. That was the heartbreaking part. She loved her family. But love becomes financially expensive when there is no margin underneath it. That pattern repeated more than people realize. Debt in your 50s often wasn't about yourself anymore. It was about carrying other people too. Your 60s, when debt follows people into retirement. According to FCA figures, adults aged 65 to 74 who still carry unsecured debt owe a median amount of around £2,300. The number falls, but the meaning gets heavier because debt feels different once income becomes fixed. One man I remember had entered retirement still carrying credit card balances, a remaining loan, and monthly repayments still leaving his pension account every month. Not because he had lived extravagantly, because life had kept happening. Children, house repairs, helping family, periods of lower income. He said something I never forgot. I thought this would all be gone by now. That sentence carried decades inside it, because most people do not imagine debt following them into retirement, but increasingly it does. What the people who escaped did differently. This is the important part. Not everybody stayed trapped in these patterns, and the people who escaped were rarely the highest earners. Usually they had simply interrupted the system earlier. They built margin. That was the real difference. The FCA consistently finds households with emergency savings are dramatically less likely to fall into persistent debt problems. And behind the counter, I saw exactly why: a separate savings account. An emergency fund, a smaller mortgage than the bank said they could afford. Driving the car longer, not refinancing lifestyle upgrades endlessly, small decisions, repeated quietly for years. I remember two men in their 40s with very similar salaries. One constantly looked successful, new car, holidays, latest tech, large house. The other looked ordinary, older car, smaller house, less visible spending. 10 years later, one still carried large debts. The other had nearly complete financial freedom, and almost nobody looking from the outside would have predicted it correctly, because the people building financial stability rarely look impressive while they are building it. That is one of the biggest financial truths I ever learned in banking. The real question is not, is this normal? Because normal debt is now extremely common. Nearly half of UK adults currently carry unsecured borrowing according to the FCA, so normal is no longer a useful benchmark by itself. Normal can still be dangerous. I think that is the part many people need to hear. You are not failing because you have debt. But debt becomes dangerous when it quietly becomes part of your identity. When carrying balances permanently starts feeling ordinary. When the overdraft becomes just how life works. That is when the system hardens around people. The people I remember most from banking were not reckless people. Most were hardworking, caring, responsible. But many were carrying financial pressure they had normalized over years, and the longer people carried it, the more invisible it became. That's why understanding the numbers matters. Not to shame yourself, to locate yourself honestly, because once you can see the pattern clearly, you can interrupt it. One decision at a time, one buffer at a time, one quieter financial life at a time. Debt thrives in normalization. Freedom usually begins in awareness. Slow down, think clearly. And that's how you start to love your money.